Hey, what's going on, Investing family? I'm Stock Market Jay, and I'm here to say today, bring you some news you can really use. So today, we definitely about to ruffle some feathers. We definitely are about to take things to another level because I've been seeing a few different things going on, and I'm beginning to understand that a lot of people aren't financially educated. People are just really following trends. People are really just blindly following people online without having done the work themselves. You should always do your own due diligence and research before investing. Of course, I'm a firm believer in that. And of course, don't even listen to me, right? Don't follow me. Don't listen to me. Cross reference, reference check, right? And build a philosophy, a hypothesis around investing before you spend your hard-earned money. If you're just sitting here asking people what you invest in, is this a good investment? Is this an investment I should be making? When I should buy, when I should sell, and things like that, then it's a good chance you're not financially educated. And this isn't financial advice. This is just pure financial education. As we jump into the Boring Investor series, of course, I am the Boring Investor. I am Stock Market Jay, and I'm gonna give it to you the slow way. Once you get off of looking to build wealth overnight, get rich quick, and you start trying to build wealth over time, implementing those steps, taking those actionable steps, doing those things that's necessary, developing those habits to build wealth over a certain amount of time, you'll begin to get a certain result. And I've learned that if you look to get rich overnight, it's a good chance you'll probably fail every day. So then investing won't be as fun or enjoyable for you. So, of course, this isn't financial advice. I'm not a financial advisor. This is just pure boring, unadulterated financial education, which is what you need. So, of course, when you're able to build an understanding around the realm of finances, then you're able to make educated decisions around the investments that you make. And I'm going to actually read this word for word verbatim. You can look this up on what financial education is. It's the process of acquiring the skills, because financial education is a skill set. Investing is a skill set, and the knowledge needed to make informed and effective decisions about your finances, and is crucial for building a secure financial future. Not tomorrow, we're looking to get rich, but 10 years from now, 15 years from now, 20 years from now, if you're consistent enough, if you have the right opportunities that come to you, you might be able to do it in five, things like that. Now, I'm not saying that you can't get a spark or a chance of luck, but as Oprah Winfrey was quoted as saying, luck is just when preparation meets opportunity. So let's dive into the financial education aspect of it, because I've been quoted as saying, the more you learn, the more you earn. I've been investing since 2020. And of course, I'm a student of the game. I study. I've studied the greats like Ben Graham. I've studied Warren Buffett. I've studied Ray Dalio. I've studied Peter Lynch. I've studied Charlie Munger. Now I'm starting to study Jamie Dimon and different amazing people that have built fortunes or run multi-billion dollar financial institutions for a very long time. And some of the things that I've learned is that literally it takes time. The more you learn, the more you earn. Like you can literally buy a stock and it literally takes time to bubble and balloon in order to, it has to grow, it has to mature, especially if you're buying it in its infancy. In times where the market hasn't taken notice to that stock, or the market hasn't found favor of their stock, or hedge funds or institutional investors haven't started investing in that stock because they might not be profitable. They might be in the early stages, startup, or, in the growth phase, which a lot of people don't want to get into. It takes time. You have to let these things continue to grow and develop over time. And as they do that, and you can track it in the numbers. This is just financial education. You can track a company's financials. This is public knowledge. You can track a company's numbers and be able to determine a history of growth. And of course, hypothesize a trajectory of growth and see where that business is going. And then, of course, if you've been done your research, then you'll know how to determine if a stock is undervalued or overvalued, right? And this just comes with time. Comes with spending time in the markets and not trying to time the markets, right? You don't time the markets, you spend time in the markets. You'll have a hard time if you're actually timing the markets. If you're timing the markets, which means you're trying to get in at the very bottom and you're trying to get out at the very top, you will see that your results aren't going to be as optimal as you would like. Reason being is because if you're trying to time the bottom, let's say you jump in and it's not quite the bottom, but you feel like you're losing, you're at a deficit. That's not a problem at all. You can keep averaging down. Or let's say you try to time the bottom and that bottom that you think is going to happen never happens. And then the markets go on a massive rally. Now you just missed out on a bunch of amazing gains, right? And that's not what you want to do. You don't want to miss out on those gains and those opportunities because, of course, understanding compounding is your friend. The more time you spend in the markets, the more time compounding gets to work for you. And the more time compounding gets to work for you, the more exponentially those investments are going to grow over time. Okay. That's how it works. So you don't want to time the markets. You want to spend time in the markets. And of course, if you think that something is at a top and you start shaving profits, taking profits and things like that, but it continues to go up, then you're not going to be excited about that. You're going to, man, I should have stayed in. Well, why did you sell in the first place? If you look at it through an investor or an owner's eyes, which is what investing, especially in equities. I can't speak for crypto enthusiasts or, speculative gamblers and things like that. But if you're an owner of an amazing business, why would you sell that amazing business just because it appreciated in value? Isn't that what you wanted it to do? Didn't you want that amazing bit? Didn't you invest in that company because you knew it was an amazing business? You knew they had solid financials and were fundamentally sound. You knew that they had an amazing management team. You knew they had a competitive advantage, a moat, and you knew that if you put your dollar into that stock, that equity, that it would grow over time. Well, if you're the founder, the owner of, let's say, an Apple or a Tesla or an Nvidia and things like that, Nvidia is a $5 trillion market cap in today's time. Do you think the person who owns that company is going to sell their entire stake of Nvidia? No, just because it went up in price? No, they're not. So why would you? So you have to take that consumer hat off and put that producer hat on and start thinking like an owner, okay? So financial education is the process of acquiring the skills and knowledge needed to make informed and effective decisions about your finances and is crucial for building financial structure. So first, one of the first components is going to be earnings and income. Earning and income. Spend less than you make, reinvest your profits or your earnings, and of course, avoid catastrophe. Those are three keys that I picked up from Charlie Munger over time, which basically is just saying if you earn $10,000 a month and you spend $10,000 a month, you're essentially gonna be flat. You're flat for the month, right? The average person today spends $1.25 for every dollar that they make. So the average person is running at a deficit. So that means is if you earn 10,000, you'll likely spend $10,100, right? And then the other component to that is going to be operating in the green, which is going to be spending less than you make. So if you spend less than you make, you'll have a surplus every single month. If I earn 10 grand a month and I only spend 9 grand a month and I put that other $1,000 up every single month, guess what's going to happen? By the end of the year, you'll have 12 grand. Lo and behold, if you invested for a minimal a 4% or a 10% return, just say for argument's sake, that's an extra $1,200 that you have on top of the money that you were able to save. Mind blown, right? So now you're getting the ball rolling. Now the ball is rolling. So now you're not operating at a deficit. Now you're operating in the positive, which is where a lot of people don't operate because the next part of financial education is budgeting and spending. If you're just joining me on TikTok, I am doing my podcast on here, and this is Financial Education. This is the Boring Investor series. I'm Stock Market J. This is the Boring Investor. Budgeting and spending, the next component of it. Track your expenses and have a game plan. A lot of people, the average person out there, and I promise you, a lot of people that listen to this are going to feel some type of way because the hit dog going to holler. A lot of people don't have a handle on their finances. A lot of people don't even look at their financial statements or their bank statements on a month-to-month basis to be able to know where their dollars are going. If you don't know where your dollars are going, that means you haven't likely given them a job in order to work for you and grow. And if that is the case, if you're not tracking your money, it's a good chance that you're operating at a deficit. If you don't know, if you don't have a plan, a well scripted out economic plan for your future, it's a good chance that you're broke or you're living check to check. Because here's the thing, a lot of people complain, oh man, today's society, you got to work 2 jobs. Oh man, in today's society, you got to do this, you got to do that. It's not enough to get by, blah, 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 all this stuff. Everything's going up. The price of goods and services, rent's going up, groceries going up, all that good stuff. Here's the thing, it's a good chance once you track your earnings and your income that you realize you don't have a earning problem, you have a spending problem. Most people in the world have a spending problem today because they spend either the equivalent of what they make or they spend more than what they make and they're operating at a deficit or they have no room, no wiggle room for anything. And here's the thing, just because I say spend less than you make doesn't mean live below your means. You can always increase your means. Some people are like, oh, I don't want to sacrifice X, Y, and Z. Don't sacrifice it. Get a side hustle. Get another job. Figure out how to make some more money and make money work for you. You don't have to sacrifice anything. You can increase your means. You don't have to be stuck in that rut that you're in. You can always strive to do more. But we live in a society where no one wants to do anything. No one wants to work and no one wants to take control of their life, of their financial life, their financial health, and their financial future, right? So most people don't have an earning problem. They earn decent money, give or take, because you can shave some money here and there. Because if you track your spending, which is budgeting, and you give your money a job, you will find the holes in your financial health right now. You will find where you're lacking at financially. You will see, man, I eat out quite a bit. You will see, man, I buy too many video games. You will see, man, I buy too many Jordans. You will see, I buy too many liabilities, which is another part of financial education 101, assets and liabilities. Assets put money in your pocket, whether it's regularly or whether it's monthly, whether it's passively, whether it's actively, who cares? Assets put money in your pocket. Liabilities take money out of your pocket. You have to understand the two. Are you spending your money on liabilities which don't generate you a return? Or are you putting your money in places where it can work for you, where it can grow, where it can appreciate in value? And that's known as an asset, okay? That's your income statement, which is your assets, your liabilities, and you have your inflows and you have your outflows. The assets feed into the income, the inflows, right? The assets feed into that column, liabilities feed into the outflows. What you have left is the net. That's what you have left over to be able to operate with, then you don't want to sit here and be in a spot because you have to essentially have things. And I always say this, if you have to have things all the time, you will likely never have anything the times that you need it because you're essentially always looking to have things to kind of maybe fill a void or fill a hole in you. And you need instant gratification. A key component to strong financial health is delaying gratification. If you're able to delay gratification, which means that I can put off this feel good feeling of today in order to generate a return tomorrow, then you will be in good standing. Because essentially, if you have that instant gratification mindset, if you always need to do something, you always need to buy something, if you need the latest Jordans, if you need the latest, keep up with the latest trends, the latest styles, the latest fashions, you'll always be at a deficit. Now, the key to this is, and mind you, stay with me, the key to this is tracking where you're putting your dollars at so you can start making more informed decisions and optimize what your dollar is able to do for you. The dollar is a willing servant and slave. It will work for you. And if you can find out a way for it to have kids, its kids will work for you, and so on and so forth, right? This is financial education 101. This is connecting the dots. And it's simple in theory, but everyone can't do it. Everyone can't take, this is how I teach my kids. 10%, you take your check, your full check every time. This is before you even pay any bills. 10% is going to be saved in a high yield savings account. We're not putting it in just a regular checking account to not earn any interest. That doesn't make sense, right? Your money should be working for you, even keep it liquid. Keep your money liquid because you want to be agile when opportunities arise. right? You want to be agile enough to take advantage of times in the stock market. If I'm a stock market investor, I invest in equity. So that means oftentimes a stock's price can become detached from its fundamentals, which means that to the upside or the downside, that stock can not reflect what the earnings and the fundamentals of that business suggest that it should be doing. And oftentimes when it's to the downside, those are buying opportunities. But you have to be liquid enough and have enough surplus of capital to take advantage of that. Why do you think Warren Buffett has what 400 almost 400 trillion dollars in Berkshire Hathaway straight liquid? Because of course everyone thinks the markets are going up right now, but in fact, the Mag 7, they're pumping the markets and pushing the markets to majority of the markets as a whole are either flat, likely the consumer staples, blue chip stocks and mega cap stocks or likely like just flat, essentially from what I've seen. And the rest of the market is lower. It's pushing down to the downside. So you want to make sure that you're liquid enough, right? That's why you want to put that money in a savings account, a high yield savings account. But you also want to ensure that you're prepared and you've got your money working in those other areas as well, right? So a high yield savings account, and this is diversification I'm about to get into. So a high yield savings, 10% saved, 10% invested. So that means your investment accounts. I personally invest in silver, physical silver, right? Not digital silver. I invest in physical silver. I like tangible assets as well. And then, of course, equities. And I have some REITs that I invest in as well. This is a method of diversification, but this is also investing. Like I said, you invest 10%, you save 10%, and then you tithe or give to a worthy cause. It doesn't have to be the church. I'm not trying to push religion on anybody. But you tithe or give to a worthy cause, 10% of your income. So that's 30% already accounted for. If you can do more, you do more. The other 70%, you're going to pay your bills with, and then you're going to live on the rest. Some people say, get some for leisure and going out and all that good stuff. There's nothing wrong with that. I'm not crapping on anyone that wants to set an amount and allocate some dollars towards leisure, fun, and things like that because you have to live. That's not my focus. My focus is building wealth, retiring early, becoming financially independent. I don't care to go out. I don't care to buy mundane things that yield no return. My focus is putting money toward in places and vehicles that can give me the greatest return on it. I'm a firm believer in delaying gratification, and I appreciate that I have those qualities. And a lot of people would stand to do relatively decent for themselves if they were able to do that. So then like I said, tithe 10%, invest 10%, save 10%, pay your bills, live on the rest. Whatever you have left over, man, do whatever you want to do with it. It's yours. Have fun. You can blow it all at one time. Here's the thing. Don't dip into that savings. Don't dip into your investment portfolio because it has to grow. It has to be able to work. Compounding takes time. Time is the biggest component of compounding. And definitely don't stop giving. Don't stop giving to that worthy cause. Giving is the beginning of receiving. And do it with a generous heart. Be a generous giver and a gracious receiver. And if you got to think about it, you're not giving, you're trading, as Bob Proctor so eloquently put it. So that's just governing your finances one-on-one. If you do that as a bare minimum, you will eventually get out of the red and operate in a positive. And here's the thing. If you save 10% of your income every single check, there's no way that you cannot have a surplus, right? Does this make sense? A lot of people don't understand this because everyone's trying to get rich quick. Everyone wants to get rich overnight, but no one has the mind frame of, man, what if I just do it the boring way and get rich over time? Like, think about how much time you spend trying to get rich every single day. You're literally failing every day. Who wants to fail at something daily when you can win at something regularly? And you don't have to follow the latest trend. You don't have to follow the latest crypto pyramid or meme coin. You don't have to day trade, swing trade, options trade to get rich. You don't have to do that. But you can make wise financial decisions because financial education is the process of acquiring the skills and knowledge needed to make informed and effective decisions about your finances, and it's crucial for building a secure financial future. That's what financial education is. You can look it up. You can Google it right now. That's where I got it from, that definition. I know what financial education is, but I want to make sure that it's known. And with that being the case, you don't have to get rich. You don't have to get rich today, tomorrow. That I would love for you to get rich tomorrow and today. Everyone that's watching this, everyone that's listening to this, I want you to get rich. Can you do it tomorrow or can you do it over time? That's the question you have to ask yourself, right? Getting rich tomorrow might be a stretch. Getting rich over the course of the next few years, 10 years, decade, or whatever, now we're talking, right? Even when you're buying stocks, man, they take at least 2 years to mature to even see a decent return on it. And that's hoping you know how to enter the market, which is going to be buying low so you can sell high, right? That's the name of the game. The next component is going to be essentially, I want to take savings and investments. I want to break that down. Here's the thing. Wages make you a living. Profits make you rich. You cannot save your way to financial independence or financial freedom. It's probably impossible. You can stop going to Starbucks as much as you want. You can cut out as many subscriptions as you want. You can save as abundantly as you like without the ability to compound, without having your money in an investment vehicle to be able to grow and appreciate in value for you. It's a good chance that those savings, it'll be a long stretch. It takes a while for you gotta think about it. Much of your income can you save a year? And then you can multiply that. Let's say if you earn what's a good wage in this time? 40K, 50K. Let's say between 40 and 50K. Let's say 60 on the high end. The average person has what's known as lifestyle inflation. Lifestyle inflation is when you earn more money and you begin to spend more money. Right. Just because I got a 5% raise now, or I got, a couple of dollars bump in pay, but now I'm spending the difference on things, stuff, outings, and the such. Well, that's called lifestyle inflation. So that means that you're going to still be in the same spot. You're just going to be essentially a well paid version of what you already were, meaning that you're not going to actually improve your circumstances at all. You're gonna have more of what you had, but you're gonna be drowning just as much, right? Because you're basically gonna be pouring more water into a bucket that has a gaping hole in the bottom, and that's not gonna help. So what you want to do is put a Band-Aid at the bottom of that bucket, stop that water from flowing out. And if you get an increase in earnings, you want to invest the difference, whether it's paying down debt with that extra money that you weren't getting anyway, or you're able to speed up your investments. You're able to supercharge your investments because that extra money, that extra 5% that you earned on your salary, or that extra couple of bucks that you earned, or that windfall of money that you got, whether it's income tax, whether it's a settlement, whatever the case may be, you're able to put it towards something. Like I said, paying down debt increases your net worth. Investing is always a beautiful thing to do with the extra income that you have, because guess what? It's able to work for you. It's able to multiply for you. Sometimes if you're smart enough, it'll pay you a dividend. Man, that's crazy, right? And it works in your favor. You cannot save your way to wealth. I'm sorry. I don't care how much you make. Let's say you make 60 grand a year. Let's say your living expenses is half of that, because most people's living expenses takes up the majority of their income. Living expenses, which is going to be your house, your rent, your mortgage, your car note, utilities, kids, food, things like that. Right? So let's say you spend half of it on that. A lot of people have that instant gratification mind, so they'll spend a decent majority of the rest on, let's say, going out, having a good time, taking trips and things like that. I know a lot of people that take trips, but their finances aren't in order. They living like they're rich on social media. They're taking these trips, but at home you're struggling. At home, you have a car that's broken down, or you have a home that needs repairs, or you have bills that you're behind on, but you're making it look good for the gram. So let's say you're doing that. Now, then let's say the other half of that 60 grand. So that's 15. So now you're left with 15 grand after that. Let's say you potentially are able to save 15 grand a year, which some people can. Some people can genuinely save 15 grand a year. And I'm not even going to account for emergencies or things coming up. Cause I mean, out of that 15 grand that you have left over out of that 60, you got to think about it. Some of it has to go into a savings, an emergency savings, a long term or short term. Some of it you would like for it to go into an investment vehicle, right? So let's say you do that and we're not even going to do that because this is just straight saving. We're not even going to add compounding to it. So you're left with 15 over. This is on the high end. It'll take 10 years for that $15,000 that you save every year to turn into 100 grand. Okay, so now we need that 100 grand that you made in 10 years that you probably could have got half the time if you would have invested it. That's to say that nothing comes up. That's to say that you are able to earn 60 grand a year. And that's to say that you're able to keep 15 of that 60. Being $100,000 doesn't allow you to be financially free. So now what's the next milestone? Now we want to get to 1 million. After you get to 1K, you need to get to 1 million. Well, guess what? You got to do that 10 times over to be able to do that. So that means it took you 10 years to get 100 grand. So another 10 years is going to be 200 grand. Another 10 years is 300 grand. This is 30 years. If you invest $250 into the S&P 500 every single month for 30 years, you'll have $1 million. From the moment you're 18 to the moment you're 50, you'll be a millionaire. That's just investing in the S&P 500 that annualizes between a 7 and 10% return per annum over the course of, let's say, the last 50 years. That's 30 years of investing versus 30 years of saving. So 30 years of investing can yield with a 7% return into the S&P 500, which is just an index of the largest 500 publicly traded American companies. 30 years of that versus 30 years of trying to get those 100 grands to add up for you. What you see the difference? That's 700 grand in the same time span that you're missing out on. Those are what's known as opportunity costs. Here's the reason why you want to get into that game, the world of financial education and investing, because everyone has goals. Everyone has things that they want to do. Everyone has things they want to achieve, especially financially, is right. A lot of people want to have a lot of money. A lot of people want to own nice houses, nice cars, nice things like that. But if you don't have decent, solid financial health, how are you going to get it? Would you rather be a millionaire in 30 years, or would you rather have 300 grand in 30 years? The same amount of time, two different approaches, two different results. Another key component to financial education 101, which is what I suggest everyone learn about, which is going to be, this is just simple economics. I'm not an economist by any stretch of the imagination. I'm just someone that's done my due diligence. I've done my research, and this has helped me be able to make more informed investment decisions for the capital that I'm allocating to grow, and in terms of how I'm living my life as a consumer, because I'm a consumer in this American economy. So that means the things that happen to everyone else happen to me as well. Point in case number one. You want to learn about quantitative easing. I just did another episode of my last podcast on inflation and different economic factors. Go back and listen to my previous episode on there. For everyone that's on TikTok watching, I have my podcast linked in my bio. It is on Spotify. Just click on it and watch as many episodes of my podcast as you like. Learn about quantitative easing. That's when the government is essentially easing monetary policy. They're lowering interest rates, making money more easily accessible, and essentially pumping more money into the economy, making people want to go get credit products, essentially. Quantitative tightening is when the government is increasing interest rates, usually as a result of inflation, because inflation is high. That's the only way to get inflation down is by tightening the money supply, pulling liquidity out of the markets, and essentially deterring people from wanting to borrow money. Those correlate. One is a result of the other, which causes the other, which makes the other one happen. It's an endless cycle of the government pulling levers that impacts your financial health every day. And these both equate to operating in a high interest rate environment versus a low interest rate environment. You want to know how this impacts you, because guess what? If interest rates have gone up, That means your debt has become more expensive. Your mortgage, your car note, your credit cards, your loans, your personal loans, your lines of credit, things like that are more expensive. You want to understand and see, because here's the thing: when interest rates went up over this past couple of years after COVID, guess what I did? I invested in high yield savings accounts and T bills, which were paying between 6 and 10% just for having money sitting there, which is crazy. I bet a lot of people didn't take advantage of that because they didn't know. The more you know, the more you learn, the more you earn. Listen to me. Operating in a low interest rate environment, a lot of people make a lot of money because debt is so cheap. You can use that money and do amazing things that supercharge and turbocharge the money that you're able to generate. Here's the thing: when you understand those simple things like that, and inflation, of course, as well, which is the reason why we invest, go back and watch my previous episode, because, like I said, I talked about this. If you learn those simple things, this will actually give you insights to understanding the financial markets, the financial sector of the markets, I should say. Banks are making a killing, or have been making a killing, because interest rates have been so high for so long. They're charging people more because people's APRs are so high that they're bringing in so much money that if you were invested in I watched Bank of America go from $28 and some point during COVID to $60 right now, because the financial sector, and this is not just Bank of America, this is a lot of banks, right? And financial institutions. They're making money hand over fist because guess what they're doing? Lending money to people that need mortgages, right? Real estate, auto loans, credit cards. People didn't stop getting credit cards and lines of different types of lines of credit. The bank is charging them more for it. So that means they're earning more for it. So that means that's a key. Man, during times of high interest rates, not only should I be in putting my money into these high yield savings accounts, these debt markets, which is what it's known as, I should be investing in these financial institutions that are capitalizing on this as well. Geopolitical factors are another component of financial education. We live in a country that does business with other countries. We live in a country where, of course, capitalism is king, meaning that businesses essentially drive this country. And most of these businesses, especially the bigger ones, are multinational businesses, meaning they do businesses with other countries and in other countries. Geopolitical factors are like tariffs, they're like wars, they're like elections, right? They're like these different phenomena that happen over time that impact your life, my life, and your investments. You have to learn how to navigate that personally for your own financial health. And then here's the thing: when you can marry that together, one more point: market and economic cycles. The economy goes through cycles, booms and busts known as contractions and expansions, or recessions, depressions, right? And then, of course, like I said, just those good times, progressions is what it's known as. And they have troughs and they have peaks, bottoms and tops, and everything in between. Those are cycles. You have to be able to navigate each of those cycles. In those cycles, guess what you have? The markets are going to be flipping. You have different sectors in the market. You have the financial sector, you have utilities, you have consumer staples, you have the consumer discretionary, I'm sorry. You have the cyclical stocks, right? Automotives and things like that. You have a bunch of different sectors in the market, and they're not always all up or all down. You'll have some that'll be up and some that'll be down. Right now, tech is really driving the markets, right? Tech is its own sector. Tech is typically a riskier asset. It's most people invest in tech when it's risk on, when they're risk on. That just means that they're willing to take on more risk because that particular part of the market is going up. When that happens, of course, it's an inflow, but at the same time, that means that they're diverging capital from other areas of the market, those other sectors I just talked about, whether it's healthcare, consumer staples, consumer discretionary, materials, tech, financial, what have you, utilities. they're diversion money and capital from those other areas and pumping it into other areas of the market. And when that happens, you'll have, let's say, 3 to 4 sectors will be up, the other will be depressed and down. It happens, what you want to do is position yourself. And this just is financial education. This is just you picking up these little nuggets over time from being, like I say, you're not timing the markets, you're spending time in the markets and you're educating yourself. So you know that when these other sectors in the markets are down, that's when you invest because you want to buy low. You understand that they're great companies and they're fundamentally still growing because, as I said, oftentimes a business's fundamentals can become detached from the company's actual stock price, right? The fundamentals can become detached from the price. When that happens to the downside, that means you buy shares, you pick up shares of a company that is wildly undervalued and is on sale. Share this video if you're watching on TikTok. Share this video. And when that happens, you're able to buy low. And then guess what happens when the market cycle rotates again? I wouldn't sell. You can sell. That's when you're going to be able to sell high, but you've already been in position, put yourself in position to capitalize on that upward movement. Once the market finally flips, those sectors rotate and those stocks that were depressed and suppressed are now going up on the uptrend, right? And then the ones that were up, whether you had took profits on them already, I wouldn't take profits. I'd stay in them. You don't see Warren Buffett selling stocks just because they go up in value. He holds them for decades. He doesn't sell stocks as they go up in value because allowing compounding to take its effect, meaning you have to spend time. Compounding needs time. Compound interest is the interest that your interest makes, and time is the biggest component and exponent. So compound interest is just the capital, principal investment raised to the power of time. That's the exponent. And the longer that time is that you're in the markets, the greater that it is able to grow and compound. And guess what? After you reach a certain point, takes off to the moon. It takes off to the moon. So that means, especially if you're earning dividends, why would you sell it just because a stock goes down in value? Why would you sell it and you're earning income from it? It's still a great company. You just buy more shares of it and let your portfolio is still going to be going up because of those other companies that you bought when they were down. And that's going to be driving your portfolio up. So you're not going to be running at a deficit. And then you're still able to earn income as well as compound at the same time and buy shares on a discount of a wonderful business that's still an amazing business. Mind blown. Last point of financial education. Share this video if you're watching. Last point of financial education. It's our capitalistic duty to invest. We live in a capitalistic society. America is widely driven by businesses. The government does influence the money supply, but they allow businesses and entrepreneurs to flourish and dictate the outcome of the economic development that this country has. Companies are the driver of this country. And that's why a lot of companies right now are, of course, doing business and deals with Trump, dedicating and pledging billions upon hundreds of billions of dollars into this country. Everyone isn't an entrepreneur, but you don't have to build a business, you can invest in businesses. You don't have to build a business, you can invest in businesses. Investing in businesses is essentially you doing your capitalistic duty to this country to ensure that it's able to grow because you live in the greatest country in the world. And I'm not getting political here, but I will tell you this. This is going to be the greatest wealth transfer that we've seen in quite some time. And it's wildly in part due to Trump. Trump is he's a economic president, right? He's not as much political as he is economical. Whether it's tariffs, whether it's bringing enticing businesses to do more business over here in the United States, or whether it is passing certain laws and removing red tape, as it's called, for certain businesses to be able to move quicker and earn more, right? So Trump is an investor's president. He's a financially educated person's president. If you're financially educated and you're able to take advantage of what the society is offering you, because we live in a capitalistic society, and it is our duty to participate in this capitalistic country that we live in, which is the greatest country in the world, you will essentially run wealth will find you at some point in time. It'll run right into you like a brick wall. It's our duty as American citizens, which I hope you're a proud American citizen, to participate in the growth of this country. And you do that by investing or building a business. You don't have to, everyone's not entrepreneurial. Everyone doesn't have an amazing idea to change the world or innovate in a massive way that can solve so many problems that you become rich, but you can invest your way into wealth. That's what today's episode is about. Financial education. This is Financial Education 101. If you're watching on TikTok, share this video, like this video, comment on this video. All my watchers, my listeners on Spotify, on Apple Podcasts, on Google Podcasts, do your own research, do your due diligence. Don't take advice from anybody. Don't even listen to me. If you take something from someone, take the meat, leave the bones. Take what works, cross-check and cross-reference with other sources, read books, read articles, do your due diligence, and you'll make wise financial decisions. You essentially walk into wise financial decisions as a result of the research that you've done. And I'm going to end with this. If you're asking people, is this a good investment? If you're asking people, when should I buy? If you're asking people, when should I sell? If you're asking people, where should I put my money? Man, you probably shouldn't be investing. You might want to spend some time educating yourself. And until next time, investing family. Peace. All right, guys. So that was it for the podcast. We wrapping it up. We're essentially done. Oh, yeah.